So finally, rate cuts are here, but let's discuss why it does not matter. So let's get into it. First off, this is the more recent history of interest rates in the United States, and the Fed was basically frozen on this level here after the pandemic in 2022. It was the most and the quickest rate hike in history, and after a certain plateau here, we got the famous pivot, but it was just one big 50 basis point cut, and that was it. And after Trump got elected, we are having this political pressure surmounting, and this is, in my opinion, way more important than whatever was said at the meeting. But the most interesting part is that the FOMC is just becoming kind of an announcement trading day, so where people are just expecting for some volatility in the markets, and that's exactly what happened. So we see the S&P. What do you take out of that? So you just have some volatility, uh, huge volatility spikes, and basically we're just going sideways. So nothing special happened except for day traders. It's a perfect day for day trading, and exactly the same thing happened to the DXY. So we see a huge drop, and it went to 96.25, and all of a sudden you have a huge reversal as well, almost back to 97, and here we are back to 97. So nothing really special happened. And if you have a dual mandate, you can ask yourself many questions. So if now we are focusing more on the unemployment and the labor market over inflation, what happened to the inflation? So are we going to the 2% target? So it's still a long-term target. They are still interested in that, but they admitted that they only have one tool for a dual mandate. So now labor is more important, especially after the 911,000 jobs that actually don't exist. And you're trying to, in some way, stimulate a market with lower interest rates. And if lower interest rates actually help, why only cut 25 basis points? So many questions you can actually ask. And why would you have a pre-scheduled meeting if that was such an important theme? Why not cut rates earlier? Why do you need to wait until today in order to do it? And if the whole market expected you to do it, why haven't done it earlier? So many questions. And actually, I would actually go for the true answer, which is the yield curve. So the yield curve really tells us exactly why the Fed is actually lagging, and it's a reactive entity and not a proactive entity. So if you see here, the Fed actually only has influence on the 1 month, the 3 month, the 6 month, and then you see here how those specific T bills are not influenced at all. So they are under 3.6%. So you see a huge demand for collateral. That's the true answer here. So the market is already pricing in for a long time, and they have a lower growth and inflation expectations, and they're looking for safety and liquidity. And this is why the whole yield curve is going down, which also busts a lot of the scare, the inflation scare from tariffs, which we have absolutely no indication of it happening, because most of the inflation that is currently happening is on the service part, but not on the tariff part. You see a very slowed economy, the real economy per se, where the labor market is actually almost in a crisis. But cutting rates is not really what saves the day here. And this is exactly what we discussed about in our latest BI report. So what to expect, and also many of our stances, and we actually told our readers about the DXY still being bearish, which is still the case, and how we are still bullish on the S&P 500. And you see liquidity literally going on over time and providing the actual plumbing for the longer term. This way, you're able to separate the noise from the actual signal, and this is our goal here. So if you want to read the full report, you can try it for free for 14 days, and then you can have access to every future one. So we put a lot of work into that, and I hope you like it. So you can click on the link of the description below. One very interesting thing that happened just before the FOMC meeting is that the US Senate just confirmed the nominee, the Trump nominee, Stephen Miran, to the Fed as a member of the board. So that means that he could actually vote. And of course, he, as being aligned to the government, he did vote to lower interest rates, and you're able to see in such a way how interesting it was in what we call the dot plot. So some FOMC meetings, they have this kind of document that provides a way to see with the members represented by dots what the expectation is for the ideal monetary policy at a specific point in time. So you have 2025 on the left, and 2026, 27, and so on. And those points are members. So you see just one dot at the very bottom of 2025, which you don't know exactly who that is, but I can give you a hint here, right? So it's pretty obvious that we do have the Trump government just trying to get their hands on the Fed. So this is a movement that we explain a lot in our BI reports as well. So it's a very, very interesting scenario that we're going to see from now on. And is it a one and off kind of thing? Are we expecting many more rate cuts from now on? Is the labor market going to push the Fed towards more aggressive cuts? We have to wait and see. But the yield curve is already a nice indication of what's happening. And every time we have an FOMC meeting, it's all of a big event, but also filled up with many contradictions. So let's see what happens. But I hope it was helpful to you, and see you on the next video.